okay, Bitcoin is a better form of money and it has something to do with this whole difficulty adjustment because it's the only commodity that has this difficulty adjustment. We're talking supply and demand economics. What does this mean for price? I mean, hash rate, difficulty adjustment. I mean, where does this take us as far as dollar price? Is there good consequences, I guess, benefits, I should not consequences, but benefits to having all these elements together when it comes to living in this fiat-based world?
Yeah, absolutely. And to me, this is where it gets most exciting. And I think before I dive into what happens is as hash rate goes up, difficulty increases. When difficulty increases, the cost of production goes up. When the cost of production goes up, the fair value of Bitcoin goes up. So before I dive deeper into that concept, I want to tie it back to gold because I feel a lot of the listeners will be able to piece the puzzles together a little bit easier once they see how it works with gold. So if you're a gold producer and the price of gold, the market price of gold is above the cost of production. And it's important to note the cost of production is the cost of bringing gold to the market, right? So we're talking about land, labor, materials, all in cost of production. In fact, the gold industry, if you're part of the World Gold Council, they require reporting of an all-in sustaining cost, is what they call it. And I would like to see the Bitcoin industry also have that same metric, an all-in sustaining cost, to help us understand where we are in the commodity cycle. And here's how it helps us. So in the gold market, when the market price of gold is above the cost, producers of the gold, miners of the gold, are profitable. And every business in the world is created for profit, right? If you run a business and you're not profiting, close it down and go get a job. At least you'll make money. So the concept of profit is super important in free market, and it is the driver of the invisible hand within the marketplace. And when the price of gold is above the cost, we have profit. The producers are producing it. And what happens is there's, like you stated earlier, Matt, there is no other commodity in the world whose supply cannot react to profitability, right? Because when the price of gold goes up and it creates more profit, more miners can produce supply. They can rip more gold out of the ground faster because they have more profit to reinvest in expanding supply. Well, Bitcoin miners cannot expand the supply of Bitcoin, but what can they expand? Their hash rate. So that's where this difficulty adjustment ties in this element. But before I dive into Bitcoin, one more thing about gold, because what happens if the price of gold goes below the cost of production? And miners will stop producing the gold. And then what happens is the supply of gold will start to drop against a consistent demand, which creates a positive price pressure. And eventually the price will go back up above cost of production as supply continues to drop. And when that profitability is there, producers will hop back into the marketplace in order to produce to gain profit. So this free market price signal, this concept is of the utmost importance for Bitcoin, because what we see is we see an algorithmic mechanism to help with sustainability and growth through the commodity cycle. The traditional system is dependent upon a small group of men at central banks who decide the price of money based on politics, based on emotion, and they're not data dependent, even though they say they are. Bitcoin is mathematically and data dependent on the real numbers, the real profitability, the real cost of production. So that's that added element where we, the people who are savers, who want to store our value through time and space, we don't have to depend on a group of men. We can depend on a mathematical algorithm and a proof of work consensus mechanism that only cares about the numbers, doesn't care about the politics, doesn't care about the emotion. There is no emotion. And the power of that can be seen in the performance of Bitcoin. So now that we understand how that works with gold, let me tie it back into Bitcoin, because Bitcoin is, it's just an amazing design. So the price of Bitcoin will be the market price will be above the cost of production. Like we said, we can't expand the supply of Bitcoin, but we can expand the hash rate. Well, as the hash rate grows over those 2016 blocks, that pushes difficulty up. And when difficulty gets pushed up, the cost of production gets pushed up. Now, a lot of people in the industry like to focus on the peaks. You know, oh, we went to 1,200 and then we came back down. We went to 3,000, then we came back down. We went to 5,000, 10,000, then we came back down. Went to 20,000 and came back down. Went to 70,000 and came back down. But for people who have been in Bitcoin for a long time, sure, it's fun to talk about the peaks, But the definition of store of value is higher lows. And that's what this design does. The engineered component of Bitcoin with the finite supply and the difficulty adjustment, it creates value for us through time, through the commodity cycle. Because you can't escape the commodity cycle. A lot of people say Bitcoin is up and right forever. But in reality, it's up and down and up and down and up and down. But every time it comes back down, it comes back down to a higher level, much like gold, right? Gold was $20 an ounce not that long ago when we first started using it. And you could buy a really nice high-end suit. Well, that $20 today can barely buy you a t-shirt, but gold is upwards of $2,500. So you can still buy yourself a nice suit. How did that work? How did gold store that value? And the answer to that question is inflation drove that value. And this is what's so sad about where we are today and why we can't depend on man and all the politics and emotion, because we even change definitions. Most people today, and probably a lot of your listeners, when they hear the word inflation, they think or they associate it with economic growth. But inflation is not economic growth. Inflation is simply the dilution of the currency unit that loses its purchasing power, forcing all prices to increase. And that includes the producer's cost of production. So over the years, as the dollars were inflated in the gold market, what you see is the producer's cost of production went up. And when the producer's cost goes up, they have to push that cost to the consumer. Now, if they don't push that cost to the consumer, profitability declines. And if you look at the stock market today, I'm sure a lot of your listeners are familiar with the crazy price to earnings valuations and ratios that we see on stocks. And the reason that we're seeing that is because the price of the stock is being forced up through the dilution of the dollar. The cost of production of that producer is being forced up. So the profitability is either staying the same or shrinking. But when you have real economic demand, when we talk about true supply demand dynamics, real economic demand will only slightly increase the cost of production, not equally push the cost of production up. And what happens is that increased demand increases the price, but the price increases relative to the cost of production, creating more profitability for the producer. And then the producer can take that profit and reinvest it to lower their marginal cost of production. I'd like to explain this in the water bottle example. If you create 10 million water bottles, it might cost 10 cents per water bottle. But if you make 50 million water bottles, it might only cost 6 cents per water bottle. So see, when your cost is lowered, you can actually lower the front end price of the item, maintain the same profitability or more, but because the price is coming down, that naturally increases demand. So that's a healthy economy. We have more production and more consumption and lower prices that invite more demand. With inflation, we're getting the opposite of that. We're getting the same amount or even less production and consumption, the same or less profitability, and really just nominal numbers going up, not real profit. And nothing better demonstrates that than price to earnings ratios and pretty much everything you see in the marketplace. Well, Bitcoin doesn't have to worry about that because it was strategically designed to have an algorithm and a consensus mechanism govern the rules of that commodity cycle. So interest rates aren't going to magically change. The difficulty adjustment isn't going to magically change. There is a solid, concrete set of rules that we know that are going to be followed. And this ties into the economic powerhouse that Bitcoin really can create in all economies, because now businesses can make plans in the long term. They can make plans based off of a set base of rules rather than a wild flip. Like with interest rates, everybody's saying a couple of weeks ago there might not be rate cuts in September, but now you look at the CME FedWatch tool, and now it's an argument between, well, are they going to cut 25 points or are they going to cut 50 points? So there's no stability there. So the added element of stability in Bitcoin through this relationship between hash rate and difficulty and the proof of work consensus really is what delivers the fair value of Bitcoin to we, the people who are trying to save our time and energy through space and time.